Hi, everybody, and a very good morning to you all. Thank you very much for joining us this morning for this K3 Hub CPD webinar, where we'll be discussing commercial property taxes. My name is Marie Wadeson, and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the group. For newcomers to the K3 Hub, there should be some information that will pop up on the screen anytime now to give you a bit more information about the K3 Hub. I'm just going to move on to some housekeeping for this webinar. So hopefully you've seen, we are recording today's session, and as usual, it'll be posted onto the K3 Hub and Quantuma websites next week. Q&A function is open, so do feel free to ask questions as we go along. Our preference, just so that the speakers know where to go to, is that we do use Q&A rather than the chat for the questions, so we can keep everything in the same place. We've already had quite a lot of questions in today, and we do anticipate quite a lot more coming in during the session. It's therefore possible we might not get through all of them. If that's the case, we have a couple of different speakers, one to cover capital allowances, and then one to cover everything else that we're going to cover today. What we'll do is we'll direct your questions to the correct speaker. Right, so on to today's webinar then in that case. So very pleased to welcome back Ros Martin. For those who are regulars at the K3 Hub, you will be very familiar with Ros and probably doesn't need too much by way of introduction. Ros will be covering ownership structures, changes to the FHL rules, incorporation of a property business, current stamp taxes issues, and minimising tax when selling a property business. But before we get started, I would like to introduce you to a guest speaker this morning. I'm very pleased to welcome Adam Louth, who is Head of Surveying at our sister company, HMA Tax, who'll be kicking off today's session with a short session on capital allowances. So just by way of background, HMA Tax is a capital allowance specialist, recently joined the K3 Capital Group, been spending quite a lot of time with us here at Quantuma and also with other of our sort of sister companies around the group. They specialise in helping commercial property owners in identifying unclaimed capital allowances to receive tax relief and refunds, and have claimed more than 500 million in allowances for their clients. They work with and provide advice to many of the UK's leading law firms, accountancy practices and property developers. Adam has over 17 years of specialised experience in capital allowances. He built his knowledge with leading multinational accounting firms and distinguished property developers. Adam has worked on and overseen the identification of hundreds of millions of capital allowances across his career, and is absolutely the man to be speaking to. Adam will provide a short update on capital allowances. I think we're expecting it to come in at about 5 minutes, and then we'll hand over to Ros for the rest of the session. Adam, welcome to the K3 Hub, and over to you.
Thank you, May. Okay. And welcome all. We are doing a brief update for you guys, and we know not everyone will know about capital allowances because we have a variety of professionals in the room. However, there's been some key changes I just want to run through with you. Firstly, annual investment allowance, known was previously scheduled to decrease to £200,000 in April 2023, but will be maintained at £1 million until at least March 31st, 2024. It enables companies to deduct the full value of qualifying investments in plant and machinery up to £1 million per year from their taxable profits. And this was a good decision to extend the £1 million AIA threshold to really help out those small, medium-sized companies, I'm sure, which some of you will agree. Secondly, full expensing is a 100% first-year allowance, which allows companies to claim deduction from taxable profits. This full expensing follows the super deduction, which enables 130% of the cost of expenditure to be deducted from profits from April 2021 through to March 2023, whereas full expensing expenditure must be incurred on or after 1st of April 2023, but before 1st of April 2026. Full expensing is only available to companies subject to corporation tax. However, whereas AIA is subject to a limit of £1 million, full expensing is unlimited. And thirdly, there's been adjustments made to this 2018 Structures and Building Allowances, SBAs, allowing it for a faster write-down of costs associated with construction in non-residential building and infrastructure, and this allowance permits businesses to claim a 3% annual deduction on qualifying costs, leading to a full relief over 33 years. We will encourage, obviously, property developers, real estate businesses, other organisations involved in constructing buildings for commercial purposes to make full use of this allowance, as SBAs would qualify for works that don't normally qualify as their structural nature, for example, steel framework to a building. And finally, furnished holiday lets, and Ros is obviously going to go into more detail about these. However, from a capital allowance perspective, FHLs are tax deductions available to landlords in the UK who rent out furnished holiday properties. These allowances allow furnished holiday let owners to offset certain costs of capital expenditures in reducing their taxable profits. There are some requirements for the FHLs, so to be included in the EEA, so Europe plus Iceland, Switzerland. A furnished property, it has to be fully furnished and available at least 210 days a year, including some other conditions. But from April 2025, the FHL regime will be abolished and FHL properties will be treated similarly to other rental properties, losing their preferential tax treatment. However, if a furnished holiday let has an existing pool of allowances to carry into the 2026 tax year, the pool can still be used. It's only new expenditure from that date that we need to adhere to the new rules. So to wrap up, the updated capital allowances is to try and help drive economic recovery and support investment in the productive assets. Services such as us, HMA Tax, can offer immediate tax relief on qualifying investments, and these allowances enable businesses to better manage, obviously, cash flow, reduce the tax burden, reinvest in growth. We will work with you to evaluate capital expenditures to maximise the available release to you as a company. And finally, the extension of the AIA, introduction of full expensing, enhancement to SBA, and expanded the R&D tax credit collectively reflect the government's commitment to growth. But unfortunately, the news losing the furnished holiday lets is obviously a bit sad, but at least we get 1p off the pints in the pubs. But thank you for listening, and I'll now pass back to Ros.
Okay, thank you. Sorry, I was just bear with me a second whilst I share my screen and then we can get started. Okay, hopefully you can now see my slides. Thank you very much to Adam for just updating us there, and if there are any questions for him or his colleagues, as we said, they will be passed over to him. Right, okay, let's get started on my portion of the presentation today. And as Marie has already said, I'm going to be running through a number of different issues. And as always, please do feel free to ask as many questions as you want to. I have got copies of the questions that have already been asked, and so I will be dealing with those in due course. Okay, so I'm going to start off just really by looking at ownership structures, and I know that we have covered these in previous courses that we've done on commercial property, but I do think it's quite good to just start off at this point because it helps to contextualize so much of everything else that we talk about. Because when we talk about commercial property, we can be talking about lots and lots of different kind of things, really. And when we are particularly talking about how property should be held, there are lots of different discussions. There is always this feeling, if you get down into that rabbit hole that is the internet, if you get onto some of these property websites, there is often talk about the fact that, company holding of properties is the best option, which we're going to look at in a moment. And actually what we're going to do today is particularly have a quick look at pension funds holding property. But when we're talking about commercial property, there is really, you need to focus on why you are holding this property. When we talk about property investment, people might have money which they want to use to buy property. And it might be that they will buy residential property. It might be that they will buy commercial property. Now, in some ways, when we are talking about commercial property, my feeling is that if you are investing in property as a commercial business, it doesn't really matter whether that is residential or non-residential, because actually you are seeing that as a property investment. You are seeing it as a reason why you are investing in property. So, you know, again, we will need to have a look at that, and we'll go through that as we go through. A lot of businesses will be holding a commercial property because of the fact that that is the property from which they are trading. And, you know, again, that may not be, the drivers in that kind of situation are much different. Obviously, within businesses, there can be situations where property is acquired where there are longer term strategies. So, for example, if you have a business which owns, say, a commercial unit on an industrial park, you may find out that the unit next door is for sale, and you think, well, actually, you know, we'll buy that. We might not need it now. We'll rent it out in the short term, but in the future, we're going to use it for our business. So there could be hybrid situations. There may be situations where you are buying a commercial property as a business, where your longer term intention is to sell the business but keep the property. And that can be where pension funds will come in. If you are actually holding property in your long term, possibly currently as part of the business, but going forward, that is going to fall away. But again, we'll look at those things as we go forward. So if you are holding property as an investment, so you are holding it so that you will get an income, whether the property is residential or commercial, you can hold it individual, you can hold it as a partnership, you can hold it in a limited company. Now, if we are talking about commercial property, then we don't have the problem of holding it personally because we don't have the interest restriction. At the moment, if you hold residential property in an individual name or in a partnership name, then you don't get a tax deduction for the interest that you have paid to acquire that property. You will effectively, you will get this tax reducer. And again, that increases the marginal rate of tax that you will be paying. The problem with holding it personally or not through a partnership, but personally, will be that from 2026, you may well have to engage with Making Tax Digital, because landlords are going to be within Making Tax Digital. Now, 2026, when this comes in, the turnover threshold will be 50,000. It will go down to 40,000 after a year. And actually, one of the announcements that we had in last week's budget was that threshold, so it's coming down to 30,000 after a year. That's my mistake. Is that in the lifetime of this Parliament, the threshold for Making Tax Digital will be 20,000. So certainly owning property personally will be something that we will need to think about. If you are holding property personally, you will effectively have a single property business, and that will everything will be pooled, the income and so on will be pooled, and that is regardless of whether it is commercial or residential. So if you do have commercial and residential, it can get quite complicated in terms of if you have got borrowings to fund property purchases, which bits of it you are going to get the tax reducer and which bit you're going to get an absolute deduction. And I may have said this to you before in other courses that I've got, but I deal with the affairs of a landed estate where we've got lots and lots of different bits of income arising. Rental property, there's a lot of rental property in terms of long-term residential lets. We've got farmland rented out, and we have this big pool of borrowings that varies from year to year. And every year we have to do this hideously complicated allocation of how that interest relief is going to work. And every year I keep my fingers crossed that we're not going to get a revenue inquiry, and thankfully so far we haven't. But I could imagine it could be quite tricky to I mean, I'm fairly happy that what I've done is logical, but you never know with the revenue, do you? Right. Basically, if you make losses within a property business, then you are just going to be setting those off against income from the same property and or properties. And we'll talk about how all this is going to interact from the perspective of furnished holiday let property in a moment. Obviously, if you have a company, the marginal rate of tax may be lower because the maximum rate of tax that your company is going to pay will be 26.5% if it's paying marginal rates, 25 it's a large company. But obviously, if you make a combination of the corporation tax that a company is paying and the amount of tax that the shareholders might pay on extracting that money, then the marginal rate of tax is pretty close to that which you would pay if you were owning property personally. And certainly that's when we make comparisons between trading via as an individual and trading via a company, since we've had the changes in national insurance contributions, those figures are very equal. Now, obviously, with property income, you probably won't have, well, you won't have national insurance contributions to worry about. So you probably are still going to be better off if you are holding the property in a company in terms of the amount of tax that you pay. But certainly it is not the huge advantage that it would have been at one point. With property investments in a company, losses can be used more flexibly, but often we find that there is a company which just owns property and therefore that doesn't really help. If you have a property which you are holding as part of your business, then you have trading premises. If you're a sole trader or a partnership, sorry, if you're a sole trader, the partnership is automatically going to be an asset of the business. You know, basically, as a partnership, you have got a lot more flexibility. It could be outside of the partnership held by individuals. It could be in the partnership as a general partnership asset, or it could be in the partnership, but where the capital value is retained by one or more partner. And so you do have a lot of flexibility, and the tax treatment can be, you know, can be quite variable in terms of what you are trying to do. I think the problem that I perceive with partnerships is that often people don't really think about what they are doing. And sometimes I see situations where people have set up a partnership type structure. They've got themselves into a bit of a pickle with things because actually the structure doesn't work very well. Sorry to be a little bit enigmatic, but I'm going to talk about a couple of examples of this when we talk about incorporation of property businesses. And so I will talk about that as we go through. But as I say, it's not always straightforward. Obviously, if you have a company business, you can again hold the company, you have the asset inside the company as a business asset, or have it held outside by the shareholder. And as we're going to talk about pension funds as well, then you could have that as an alternative if you have a pension fund. The problem, if you want to get a property into a pension fund, is often how you get it in there, and we'll talk about that in a moment. So what motivates the decision? Well, I suppose the first thing that you've got to ask, or the first question you've got to ask is there a reason to separate the trade and the property? Now, one of the obvious reasons might be liability issues. So you have some kind of intrinsically risky business, and you might not want the property in the same vehicle as the business because then the property could well be at risk if there are any liability issued. But that can sometimes be achieved by having a group structure where you have the property separated from the trade, and so that is certainly an alternative to actually having property outside of the company if you've got a company structure. If you have your property in a separate company from your trading business, there is no automatic overlap between liabilities. Now, sometimes you might find that people to whom you owe money will want guarantees, but that's a different issue. As we've already said, one of the things which might motivate you to keep a trade and a property separate will be because you are thinking that you will hold on to the property once you have got rid of the business to give you an income stream. There are plenty of people who have effectively used the ownership of property as, you know, their forward pension, whether or not it is actually in a formal pension scheme. Now, this slide was obviously written before we had the budget. Obviously, property outside of a company will only get 50% inheritance tax. But now, of course, we know that there is a suggestion afoot that there is going to be a restriction on business property relief and indeed agricultural property relief going forward. They've made this announcement and there is now a huge controversy about it. And so it may well be that effectively there will be amendments to that proposal. And indeed, one of the things that we're going to talk about this morning is the fact that now we have a potential restriction on BPR and APR. It may well be that people will be thinking about exactly how they want to hold property, and perhaps thinking about doing some planning in terms of what they do with property. And this is going to become very relevant. I mean, I'm sure that you are the same. I already have clients who are basically jumping up and down saying we're suddenly going to have a huge IHT liability from 2027, I should say. We've got another 2.5 years before it comes in, although that time will go very quickly. You know, we've got to think about restructuring. What are we going to do? And again, I will touch on that as we go through this morning. Obviously, holding property outside of the business, normally we would be looking at charging rent. If you are an individual who holds property outside of your partnership business or your trading business, you don't have to, your trading company, I should say, you don't have to charge rent. If it's actually a partnership business, the rent is simply part of the profit share. And you need to remember that because of the national insurance implications of that. If it is a trading business and you have partnership property held outside the partnership, you would not be able to allocate part of the value to the rent and not pay national insurance contributions on it. Obviously, if you are renting to a company, the rent will be taxable on the owner. They will be able to deduct interest on money that they've borrowed. You would have the advantage in that situation that there wasn't any national insurance contributions, but you have to be really careful in that situation about incurring costs on the property, because what you often find in situations where you have a shareholder owning a property outside of a company and then the company trading from that property is that the company will incur costs. Now, depending on the nature of the lease, there should be, if the company has a repairing lease, then they shouldn't have any issues with claiming tax relief for revenue costs. But as Adam would tell you, I'm sure there can be quite significant complications if you don't have a formal lease in place, because then the company may well not be able to claim capital allowances if there isn't a formal lease and improvements are made to the property by the company, then it may well be that the revenue will argue that there is a benefit in kind arises to the individual. And there can also be problems about whether the company can be compensated for the cost of any work, so that the company can claim the capital costs against the capital gains on any subsequent sale. And I have seen all of those issues arising in particular scenarios where the revenue have challenged, and there has also been case law on those areas as well. So it is not something that you need to be complacent about, really. If you don't charge full market rent, then there may be a limit on the level of expenses that the landlord can claim. There's no absolute restriction, although arguably there could be. But HMRC basically say that you can't create a loss. So if you have expenses and you're not claiming full market rent, then all you can do is end up with a situation where there is no tax charge arising. So, again, you need to be careful about that, because excess expenses cannot be carried forward and set off against income in a later year. Obviously, interest relief isn't necessarily relevant, but would be relevant for repairs as well. So again, just need to be a little bit careful when you put those kind of structures in place. Finally, you need to be careful if there is a formal if there is a formal lease between the parties, where rent is not going to be paid, because that can actually give rise to a capital gain, because transactions between connected parties have to be at market value. And if you grant a formal lease interest to a connected party, then that is a capital transaction, and you would have to value the lease. You would have to apportion the costs using the A over A plus B formula, and you would have to calculate the capital gain. So basically what we're saying is that the uplift to market value is by way of this so-called imputed premium. As I say, it is only going to be an issue if there is a formal lease in place. But, for example, if the tenant is going to claim the cost of works, they would need to have a formal lease in place. Sometimes if there are borrowings on a property, the bank will insist that there is a formal lease. So there are situations, and again, I have seen this in practice, there are situations where it is not entirely straightforward. So let's just talk about pension funds. Obviously, small businesses tend to have either a SIP, which is the default these days, or you can sometimes have SASs. And if you have got sufficient funds in your pension fund, and you were looking to buy a property, then utilising your pension fund to buy that property can be a very cost-effective way of doing things, because obviously pension funds, don't pay tax on their income, so you can pay rent from your rent on your property from the company. You would get tax relief in the company, and you would get there would be no tax in the pension fund. The property could be sold without there being any capital gains in the pension fund, and obviously you are acquiring an asset which is then going to be able to fund your retirement. A SIP is the one we see most often. There are a range of investments that can be held by a SIP, and commercial property is definitely one of those categories. Obviously, any contributions made to the SIP would get tax relief. SIPs are limited, and in fact there is a limitation for a SAS as well, so this is not a distinction between the two, but a SIP can only borrow at 50% of the value of the property rather than buying it outright, which would mean that sometimes we do get a funding gap if the pension fund is not of significant value. And as I've already talked about, in-specie pension contributions are quite problematic. The Revenue's view is that in order to get tax relief on a pension contribution, it has got to be cash. It is not because and that is because the legislation talks about a contribution having been paid. And so there is case law which supports the view that that means that you cannot have a transfer in specie of a property. I mean, these days when we have a relatively low annual pension allowance for the individual, an in-specie pension contribution might be quite problematic anyway, if there are significant values involved. Now, HMRC do say that you could make an in-specie pension contribution by agreeing to pay an amount to the pension fund and then satisfying that debt by the transfer of a property. But I, for one, am quite sceptical about the extent to which it will be easy to get that kind of paperwork in place. So I think you would have to be very, very careful. So the biggest problem that you would guess and get is, you know, possibly getting value. But if you have already got, you know, a well-established pension fund, then it may be possible to do this. SASs are very similar to SIPs, but do tend to be used more for larger pension schemes. So perhaps for a workplace or occupational pension scheme where you've got employees, although there is no restriction on company directors being a part of that. Again, they can definitely invest in commercial property, but they have the same restriction so that you can only borrow up to 50% of the value of the property. But of course, if you are making contributions on behalf of your employees, there may well be a larger pool of money, although it does depend on you know, the actual size of the company. Now, for both of them, permitted investments do include business premises of all types, and not student halls of residence, but not student accommodation more directly. So halls of residence, I think, have become quite a popular investment class, particularly for larger pension funds. I know that when my daughter was at university, all of the halls of residence at her university were owned by the Unison Pension Fund, the public sector workers' pension fund. So I think, you know, historically they have been seen as being a good thing to invest in. But again, possibly with smaller pension funds, that's not going to be possible. If you do have a property with a small residential element, the residential element can be held by the pension fund. And the example that's given on the slide, which is the example that's often always given in these situations, is a shop with a flat over it. That kind of situation you can have held by a pension fund, as long as no one who is a beneficiary of that pension fund is going to be living in the residential property. It's quite important that the tenant is paying a commercial rent. And as I've said, rental income is tax-free. And so, excuse me. Now, I did come across a quite interesting case a couple of weeks ago where I had a client of a client who was panicking about all of the rumours that were swirling around about the fact that the Chancellor was going to do something about pension funds, and in particular, there was discussion excuse me, bit particularly cough today. In particular, there were rumours going around that the tax-free lump sum was going to disappear or be severely restricted. And this individual had their business premises in a pension fund, had been there for a number of years, and they wanted to get their tax-free lump sum out of that pension fund, but it was illiquid. So I don't know quite what had happened to the cash rent that had been being paid, but effectively the pension fund came back and said, well, we can't pay you your tax-free lump sum because before the budget because we don't have the cash. And so he went away and thought about it and said, well, how's about you ask for the rent from my company up front? So I will get my company to pay you 2 years' rent in advance. And I would expect it to be slightly discounted because of the fact I'm paying it in advance. And you can then use that cash to pay out my tax-free lump sum. And the pension advisors came back and said, oh, no, you can't do that. It will breach pension rules and there will be a significant tax charge. And I'm not a particular pension tax expert, to be honest with you, but I don't like that kind of vague advice because I think that I know that I do it. I sometimes hide behind being slightly vague because something about what someone is suggesting doesn't seem quite right. But I either can't find anything, but I'm basically hedging my bets. And I might be completely wrong, although what subsequently transpired doesn't make me think that, because the pension advisor was then, oh, well, no, I just assumed there'd be a problem and I'm not giving you tax advice anyway. We couldn't get anything concrete from anybody about whether there was a tax problem. I didn't give tax advice on it, and I'm not sure anybody did really. And so in the end, it was down to the individual to decide whether or not he was going to take the money out. And I actually don't know whether he did in the end, whether they actually managed to get it out before the budget, where of course it would have been irrelevant anyway because there were no changes. So yeah, so it is something that is worthwhile looking at. I would have to be honest with you and say it is not always something that is possible to work through, but it's definitely worth something that's worth looking at. Other alternatives, commercial property is very much an asset which is seen as being attractive as a way of diversifying an investment portfolio. But of course, often we're talking about quite large amounts of money. Certainly there are plenty of investment products out there which enables you to invest into commercial property indirectly. But again, one of the problems that you have is the high illiquidity of property. And, again, it's not an asset class that you can easily sell. It may not be an asset class that it's easy to, get borrowing on easily. With commercial property, there are situations where funds actually have to freeze the ability to withdraw money because of the illiquidity of the portfolio. And there have been a number of quite high profile situations recently where investment into commercial property funds have had to be frozen because effectively people are wanting to do that. Indirect commercial property funds do exist. They're listed shares, so again, they're less likely to be illiquid. And then we have things like real estate investment trusts, which are, of course, a particular vehicle designed to enable investment into commercial property. There is a lot of value within REITs within the UK, but there's only a few of them. So we've got a small number of very high value REITs within the UK, but not that many smaller ones. But you know, there are those possibilities if you want to invest in property in absolute terms. Okay, I'm going to try and answer the question sort of at the end of each section, unless I see a question which is very pertinent to what I'm talking about. And we've had a question come in: is there any time limit on the lease in terms of the length of the lease to trigger CGT on rent at undervalue? In absolute terms, no. So basically, if you had any length of lease, if you weren't going to charge a rent, then there could be a capital value ascribed to it. Although, of course, the shorter the lease, the smaller the potential premium that would be imputed. So possibly it's not something that we would need to think about too much if we had very short leases, but theoretically, there isn't any time limit on the length of the lease that will trigger a capital value. Any tax implications of transfers of commercial property from a limited company to a SIP? Well, this is why there is an issue, I suppose, with whether or not you are making it as an in-specie contribution, which, as I've already said, can be quite difficult to achieve, because if you had a limited company transferring a commercial property to a SIP, where the SIP was actually paying for it, that would just be a disposal for the company, and they would pay corporation tax on any uplift. And obviously that is one of the reasons why, and I do apologise, I did meant to mention this when I was talking through the slides, but as is sometimes the case, you just skip over certain things. Obviously, if you had a capital gain arising, but you've then got it being treated as a pension contribution and deductible, then you mitigate the tax liability. But most of the cases that that I would come across, you're actually going to have an arm's length sale. And if there is an arm's length sale, then there would be stamp duty as well, or stamp duty, land tax, or LTT or LBTT. And an in-specie contribution into a SIP would not attract stamp taxes. But if the revenue is saying you can't do that unless you have created a pre-existing debt, then again, that would generate a stamp taxes liability. So that is why it's actually, in reality, quite difficult to get a property that is already owned within the business into a SIP. If you have the funds to buy a property directly into the SIP, that is going to be much the best thing to do. But of course, you know, that doesn't help a business which is a new business, where you don't have an established pension fund to be able to buy the property because of the limitation on borrowing. So it's all well and good us saying, yes, of course, transfer into a SIP, but there are issues with that. Okay, furnished holiday lets. Now, I'm aware that this is, of course, about commercial property, and I'm aware that furnished holiday letting is letting of residential property. But I'm including it because I think that for a lot of people who are, or who have historically invested in furnished holiday lets, they are looking at it as a commercial enterprise. They're not really thinking about it as residential property. And down the years, I've had a number of questions where people have said to me, well, you know, in terms of, you know, capital gains, for example, and having to report a disposal within 60 days. Well, it's furnished holiday let, so it's commercial. So I do think that for some people there is that idea. So just to recap, this was an announcement made by Jeremy Hunt in his final budget in March, that there was to be a change in treatment of furnished holiday let property. We haven't actually had very much detail beyond that, but we had draft legislation published along with explanatory notes to confirm that these provisions are coming in. And we've now actually had the finance bill published following the most recent budget, and that confirms what was there. So effectively, we are going to have this change coming in from the 6th of April next year, 2025, for individuals and partnerships, and from the 1st of April 2025 for companies. And putting it very bluntly, furnished holiday let property will no longer have special treatment. It is simply going to become just another part of someone's ordinary property business. Now, obviously, property businesses are divided by UK and overseas, and furnished holiday let treatment was available for property within the European Economic Area. So it's not necessarily going to be that all of the furnished holiday let property is going to go into the same business, but we don't see many people who've got overseas furnished holiday let businesses. And so they will simply become part of your ordinary property business, and they will be subject to the same rules as those businesses. The main impact is going to be that if you have got residential property, which of course furnished holiday let properties will be, you are no longer going to be able to claim a deduction for the interest costs. You will get a tax reducer. And when this happened in 2017 for wider property businesses, lots of calculations were done as to how much additional tax people were going to pay, and that same issue is going to apply for this current change. No capital allowances. So as Adam was mentioning at the beginning, currently we have a situation where if you buy assets for use in a furnished holiday let, you can get capital allowances, annual investment allowances, so on. These assets will no longer qualify for things like business asset disposal relief, holdover relief, rollover relief, and so on. This will not be income, net relevant earnings for pension contribution purposes, although I would have to say that that's not something that I've particularly seen a lot of. So that, you know, with effect from next year going forward, that is going to be the way that we calculate the tax position for those businesses. But obviously there are transitional provisions that we need to think about. Before we do that, though, I just want to remind you that if you have got furnished holiday let property that is held jointly between a husband and wife or between civil partners, there is another thing that we do need to think about, because currently furnished holiday let property does not fall within what are called the Form 17 procedures. So with most property rented out, if it's held between spouses or civil partners, you split the income 50-50, unless the underlying beneficial ownership is different, in which case you can put in place a Form 17 and you can have the income split according to the beneficial ownership. Furnished holiday lets are specifically excluded from that. But from next year, from the 6th of April 2025, furnished holiday let property will fall within the Form 17 procedures. So if you have got husband and wife or civil partners owning furnished holiday let property and splitting the income other than 50-50, you will need to make sure that you can actually split it as you want from the 6th of April, because one thing that's very important is that you can't backdate a Form 17 declaration. It's got to be signed and sent to the revenue within 60 days of signing. But it's going to be no good thinking about this when you are doing the 25-26 tax return, and thinking, oh, actually, we want to split this something other than 50-50, because if that's, you know, summer of 2026, you're not going to be able to backdate a declaration back to April 25. So if you have got clients who are in that position, you really do have to come along now and be thinking about what you've got to do in order to achieve a different split. Okay, transitional provisions. There are broadly 3 sets of transitional provisions to think about: capital allowances, losses, and capital gains tax. So very good, a very positive point in relation to capital allowances is that there are no clawback of allowances that have been previously claimed. When these proposals were announced in March, there was a lot of concern that you're going to have to do some kind of analysis of what the market value was of your assets on which you claim capital allowances, and effectively sell them out at market value and pay tax on any balancing charges. That is not happening. So effectively, it is benign. You just can't claim for new acquisitions, as Adam said at the beginning, but you don't get clawback of anything you've claimed already. And the other point is that if you do have an unrelieved pool of expenditure at the point at which these proposals are implemented, then you can actually continue to claim writing down allowance against future rental income. So that means that, to be honest with you, I don't see that there will be many situations where there is unexpired expenditure, because most people will be claiming, will have claimed annual investment allowance. But there will be situations where that hasn't happened. But you will be able to carry those that unexpired expenditure going forward, and then you can claim writing down allowance against your future rental income. And one important point to notice is that it is total future income. So it's not just against your furnished holiday let income. You don't have to stream it in any way. It is going to be, it is simply going to be against your total property income. What it does mean is that there might be some advantage in actually accelerating income into the current year, claiming your capital allowances, and not worrying about any clawback in the future. Because certainly when these provisions were first announced, I had a couple of clients who were thinking of incurring costs, and I said, well, let's wait and find out what's going to happen with them first. But that now is fairly straightforward. Losses. Had a question here: will losses carried forward be categorised as property losses? Currently, furnished holiday let properties can only be set off against property income arising from the furnished holiday let business, but this is one area where we have got an advantage going forward, because these losses will be able to be set off against total property income. Yeah, there's not going to be any kind of restriction. It's not going to be streamed against furnished holiday let derived income. Now, I mean, this may well be a bit of a poison chalice in some way, because obviously the amount of tax reducer that you can claim is restricted to the rental profits. So if you've got losses reducing your rental profits, that might be unhelpful. But again, that's just what it is. If you're holding property in different capacities, so sole trader, partnership, and so on, then your losses will be ring-fenced against each of those businesses. Capital gains tax. As I've said, reliefs are broadly just not going to be available for transactions after implementation. But again, the transitional provisions are interesting. If you have a relief that requires conditions to be met, and those conditions can only be met after next April, then you're okay. Probably the most obvious one is rollover relief. And again, I did have a question about this over the summer. Somebody wants to buy a furnished holiday let property and roll over again into that furnished holiday let property. It sounds like a bit of a balmy idea to me, but you know, there we go. Somebody wants to do that. In order to qualify for rollover relief, it has to be a qualifying furnished holiday let business, which would mean that you'd have to trade as a furnished holiday let for 12 months. That 12 months obviously takes you over next April. But as long as you would qualify within that 12 months, then you would get it. The other thing is that business asset disposal relief, once you have ceased, can be claimed up to 3 years post cessation. And if your furnished holiday let business actually properly finishes before next 6th of April, then you will have 3 years to sell your properties and be able to claim business asset disposal relief. Although, of course, one of the announcements we had in the budget last week is that the tax rate for BADR is actually going up to 14% next April and 18% the April after. So the actual advantage of it being categorised as BADR qualifying is going to be limited, but it could apply. This is only going to apply if you actually cease your furnished holiday let business after that date. The change in these rules is not going to be cessation for that purpose. There are some anti-forestalling provisions, and these actually apply right back to the 6th of April when this was first, 6th of March, sorry, when this was first announced. If you exchange contracts, but you don't complete until after next 6th of April, then you may not get the relief that you want to claim unless you can argue that the transaction has not been entered into for the purposes of avoiding the impact of the abolition of furnished holiday let treatment. And you actually have to put that statement within your tax return. So if it's a genuine sale of a furnished holiday let property, which you simply don't complete in time, then you will be fine. But if you're undertaking a transaction with the deliberate intention of manipulating the rules, then you may have a problem. Okay, we are going to have a break in a minute, but we have had a couple of questions coming in. Will there be cases where furnished holiday let treatment will still be classed as a trade for significant activity, etc.? It's a really interesting question, because the ICAW particularly, but other professional bodies as well, when they found out that furnished holiday let property was being abolished, really pushed the revenue to acknowledge that there could be some situations where furnished holiday let businesses would be classified as trades. And as far as I understand it, the revenue have absolutely stonewalled them on it and have basically said, well, we don't envisage there being any situations where a furnished holiday let would be classed as a trade for significant activity. But I think that there could be arguments in that respect in some situations, which would give rise to some interesting arguments, I think. So I think the revenue's intention is that no, it will never apply, but I don't think that that really is good enough. Let me just read this. If the 24-25 tax year is the first year of furnished holiday let and the property qualifies in its first 12 months of rental, does it have to meet the rental condition before the 5th of April 2025? Say it starts before being let in May 24 and only meets the required days in April 25. Is that too late? I think, Tom, the answer to that question is yes, because if the bit about meeting conditions after next April is within the bit about the transitional provisions for the capital gains tax purposes. Now, I do need to go back through the draft legislation again, but I have got a feeling that if you don't already qualify by April 2025, then you are not going to qualify for the year. But I would have to say that I hadn't really thought about that. I think that would be my conclusion based on what I can remember in the draft legislation. But I don't know. My suspicion is that you wouldn't qualify. Going back to a question on pension funds, someone said, my own experience has been that pension managers have insisted flats above shops are held outside the pension scheme. My presentation would indicate that that is correct. That is incorrect, sorry. I think the difficulty is that the pension fund manager can make a decision as to whether or not they want to buy or allow a particular asset. My understanding is, and as I've said, I'm not a pensions tax expert, but my understanding has always been that if you have a single property being purchased that has a residential element in it, then it would be possible for that to be held within the pension fund. But there are restrictions on it. So as I've said already, you can't allow anybody to occupy it and so on. And so I wouldn't necessarily disagree with you that most pension managers will not want to have any residential property at all. And I think they're also alive to the fact that, there may well be changes in rules, they may well change the regulations, and they could well be left with a property that they can't necessarily sell very easily. So I wouldn't necessarily disagree with the fact that in the end, it's going to be up to the pension managers to decide what they want to do, and they may well be slightly resistant to that idea. Okay, well, I make it about 3 minutes past 10 now, and we're going to have a break effectively every hour for this presentation. So I think that's a good point to have a break now. It'll probably be just over 5 minutes. It's however long it takes me to get downstairs and make myself a cup of tea and come back up, really. But it'll probably be about 10:08, 10:09. If you do have any questions which occur to you during that break, please feel free to pop them into the chat box and I will deal with them. Otherwise, I will see you in around 5 minutes. Okay, welcome back to the middle of hour of this session this morning. Okay, so we have the next section is going to be about incorporation of a property business. Now, again, there is a difference between first thing I should say is that obviously the question of whether or not you want to put your property business into a limited company is always going to be is always going to be an interesting one. But certainly people have thought about this in relation to residential property, mainly because of the interest restrictor. And I think it is now coming back to the forefront of people's planning because of the issues with furnished holiday let property. So those people who have got extensive furnished holiday let portfolios will be thinking, well, would I be better off going into a company? I've always been able to claim my interest relief before. I can't any longer, and therefore maybe I would be better off going into a company. I suppose it's important to consider whether the drivers exist when we have got more traditional commercial property. So I'm just going to put a cough sweet into my mouth to hope it stops the tickle in my throat. I think that the decision as to how to hold commercial property is a different one because of the fact that you do get the full interest relief. I think there's certainly different drivers involved for purely commercial property. But to a certain extent, it is easier to get property into a company if you have got commercial property rather than residential property in some ways, although it depends, as we will see in a moment, what you're using it for. Obviously, it comes down to marginal rates of tax in many ways. As we've said already, corporation tax rates have gone up, dividend rates have gone up. If you're wanting to get money out of your company to create an income stream, it may well be that you're not going to save a lot of tax by having it in a company. But of course, many people are looking to reinvest money into new property, perhaps have different family members who might have low rates of tax to get shares, or use these kind of companies to shift wealth into the next generation. So whether or not you're better off operating through a limited company, as I've already alluded to, is really not a clear-cut decision. And with commercial property, as I've said, because there is no issue with interest rates, then it's something that may well be more difficult to think about. So when we transfer property to a limited company, then it is disposed for capital gains tax purposes, and it is also a transaction for stamp duty land tax purposes, or LBTT or LTT. It is a land transaction for stamp taxes purposes. So it will be a connected party transaction. So in the first instance, it is going to be a disposal with proceeds equal to the market value. So in the absence of any reliefs being available, then you are going to have a CGT liability on transferring it into the company. Now, if you have got a property that you are transferring into a limited company, which is something like a business asset, perhaps the current business premises, then you will be able to claim holdover relief. Section 165 allows you to transfer it in for consideration of no more than the original base cost, and you can hold over the capital gains tax liability. You could decide to pay a little bit of tax if you wanted to, get a bigger loan account in the company, but you don't have to. You can gift it across. And holdover relief is a joint claim. Now, one of the things that you do have to think about is that if you were transferring a property into a company which you did not wholly own, then there might be IHT issues because there would be a transfer of value. And it can't be a potentially exempt transfer because you are not transferring the value to an individual. And that is something that people do overlook. So, say, for example, you've got the current business premises and you decide that you are going to gift it into a company that is owned by your children, that could actually give rise to an inheritance tax liability, which may not be something that is very welcome. Probably what you would have to do in that situation is transfer the property into the company in exchange for a loan account, although unless it's full market value, there's still going to be an issue. So it is something that's quite problematic to get around. If we are looking at a wider portfolio, there is the possibility of claiming relief under what is called Section 162 of TCGA 1992, called Incorporation relief. What happens there is that effectively any capital gain that arises is rolled over into the shares. One of the things you've got to remember with incorporation relief is that there is very, very limited ability to create a loan account. But the company does acquire the property at market value. But one of the key issues with this particular point is that you can only do this if there is a business. And these principles apply equally where you have got a portfolio of residential buy-to-let property. So one of the questions we've got that's coming before the session today was, could I cover the incorporation of a husband and wife partnership owning a portfolio of buy-to-let properties? Well, exactly the same principle applies. You transfer it into a company, you can create you can claim incorporation relief, but only if there is actually a business. And this is where it kind of gets slightly difficult. Now, we had a case a few years ago involving a lady called Mrs. Ramsey. Now, Mrs. Ramsey won her case, but I would have to say that I'm not sure that it is necessarily very helpful to other taxpayers. What you've got to do is try and differentiate between a business which is mainly an investment business and what you are doing is really just supporting your investment, or a case where you have active management. So going back to the point that we were making about furnished holiday lets being a trade, then you have got the same kind of ideas. Now, so if I own a single property that I rent out and I have to pay a plumber to do a repair to the bathroom, and I've got to sort that out, I've got to find the plumber, I've got to let him in, you know, I've got to do all of those things. That is just maintaining my investment. So I am managing the business, but very loosely, and therefore it's not really a business within the terms of this. Now, in Ramsey, Mrs. Ramsey had a house of multiple occupation. I think there were about 8 rooms, and she argued that she spent between 20 and 30 hours a week at this property. She cleaned the communal areas, she did the gardening, she put the rubbish out, she acted as a carer for some of the occupants, she sorted the post, she did all of these things. She took on the tenants, dealt with all the paperwork, dealt with all of the repairs, etc., etc. So the fact pattern doesn't actually translate very well to other companies, other businesses. What the revenue will look at is the amount of time that you spend, what you are actually doing, and what else you do. If you've got a full-time job, it's probably going to be very unlikely that they will accept that what you've got is a proper business. There is no pre-clearance, so you can't go to the revenue and ask them if they will agree that this is a business before you do the transaction. And once you've done the transaction, you can't undo it. And so there is a degree of jeopardy involved in this. I mean, obviously, if you've got someone who's got 100 properties that they're actively involved in managing, I mean, if they've just got an agent that does it, then it might be difficult. But I think that there are some issues. Now, in some ways, if you've got commercial property rather than residential property, often the landlord is more involved, but that's not inevitable. And so we have to consider these issues. My understanding is that the revenue are kind of, well, if you spend more than 20 hours a week, then that's fine. If you spend less than 10 hours a week, it's probably never going to be a business. And if you spend between 10 or 20, it will depend very much on what you're doing. So that's kind of the parameters that the revenue work to. Let's just have a look at a couple of questions that have come in. If a husband and wife are running such a business in partnership, would national insurance contributions be payable whilst they're in partnership? National insurance contributions should never be due on rental income. When incorporating a property partnership, does the percentage shareholding in the company have to mirror exactly the partnership profit shares and all the partnership's percentage capital interests in the partnership properties? Again, that's a really interesting question. And it goes back to, well, no, there's a couple of issues here. I think that this is, again, another one of those issues that gets overlooked. Now, we're going to talk about the stamp taxes issues in a minute, and I'm sure, particularly given the nature of the questions that have coming in, people understand that you need to have a partnership rather than joint holding of property to get stamp taxes reliefs. Now, I had a case recently where a mum had owned property. She'd gone into partnership with her son. He had a very small income share, but she had retained 100% of the ownership of the properties. And they were talking about incorporating this partnership into a company in exchange for shares. And her rolling the gain over into her shares. Now, they were wanting to have 50-50 shareholdings. But the problem is that the way that Section 162 relief works, if she'd only had 50% of the shares, then actually the value of her shares would not have been enough to absorb the whole of the gain. Because basically the value of the shares that you get is a proportion of the net asset value of the properties that are going in. And this can be a problem even when you don't have a mismatch in the shareholdings. But if you've got a high gain and a low property value, and that might apply, for example, if you have got very highly geared properties, then you don't have enough value in your shares to absorb all of the capital gain, and therefore you can't roll over the whole of the gain, and some of the gain arises on the incorporation. So if you don't have mirror shareholdings, there can be problems, although it depends on the calculation of the different issues. But that then brings us back to the question about transfers into companies and the IHT issues, and that takes us back to the previous slide. And somebody asked me, could I explain why a transfer into a company is not a pet? Because if you look at the legislation covering pets, it talks about when there is a transfer of value to an individual. Now, in this case, there is a transfer of value to a company, and the transfer of value would be calculated dependent on what you owned before and what you owned afterwards. But because the transfer of value is actually to the company rather than to the individual, then it can't be a pet. And again, I have seen cases where the revenue have made that argument. So that is the problem that you have. So even if you are confident that you are actually going to be able to argue that there is a business such that Section 162 applies, then you are going to also have to check the figures. There is no doubt about it. Moving on to the stamp taxes issues. Normally, if you transfer something where there's no consideration, i.e. you don't receive any payment for it, then there wouldn't be any stamp duty land tax or land buildings transaction tax in Scotland or lands transaction tax in Wales. And I'm just now going to refer to SDLT because the rules are the same regardless of where you are. But the exception is that if there is a transfer to a connected company, then there is potentially going to be SDLT based on the market value. However, that does not apply where you are transferring from a partnership, because the partnership provisions take priority. Now, the one thing it's very important to remember is this is not an exemption. When you're looking at extracting property from a partnership, you have to calculate something called the sum of the lower proportions. And if the calculation of the sum of the lower proportions is on your side, then there is no SDLT payable. Now, the sum of the lower proportions is basically what you retain. And that might seem weird because you're transferring your partnership interest into a company. But what you look at is what you owned before, and then what you and anybody connected with you owns afterwards. So if you've got a husband and wife partnership, they own 100% of the property beforehand because they're in partnership. They transfer it to a company which they control. They still own 100% of it because it's now owned by somebody connected with them. And so the formula is 100 less the sum of the lower proportions multiplied by the market value. If you own 100% before and 100% afterwards, even though it's through a different vehicle, the sum of the lower proportions is 100. And so there's no SDLT because it's basically the market value times 0%. But you do have to be careful. Just to give you a couple of examples, and this is the first one. Partnership with husband and wife who split income 60-40. They transfer it to a company where the shareholding is going to be split in the same way. The company is connected to both of the parties because for the purposes of determining who controls this company, the shareholdings of the two individuals are attributed. So both the husband and the wife are connected to that company. That means the sum of the lower proportions is 100 and there would be no stamp taxes. But if you had a partnership with two unconnected individuals who were splitting income 60-40, and they wanted to transfer that into a company where they were also going to hold the shares 60-40, that company is only going to be connected with the one who owns 60%. So in that situation, the sum of the lower proportions is 60, and therefore the company would pay SDLT on 40% of the value. Now, when we're looking at connected individuals, it would cover husband and wife, parents, grandparents, children, grandchildren, siblings. Doesn't cover things like aunts and uncles, nephews and nieces. So in very complex family structures, that can cause problems. But in most family cases, you're okay. But then again, we've got to think about whether there are any capital gains tax or inheritance tax implications in doing this. What about if you have 50-50 companies? So if you have a company, so let's just say in that previous example, the two individuals have 50% of the shares each. In that case, the question as to whether they were connected with the company would depend on whether they were acting together to control the company. If they were acting together to control the company, then both of them would be connected with the company, and therefore the SLP would be 100, and there would be no SDLT. But if they don't act together to control the company, then neither of them are connected with the partnership, and therefore we wouldn't be looking at the partnership SDLT rules. Suzanne's asked, is a trust a connected individual for SDLT purposes? if the owner of part of the property is a trustee of the trust. Trusts can be connected in certain situations. Now, to be honest with you, I can't remember, but because the owner of the property being a trustee would not be sufficient to mean that you are connected. The connection is through a slightly different route. Let me just very quickly see if I can put up the legislation. Sorry. I'm probably not going to be able to very quickly find this. There are particular provisions as to when a partnership is, who a partnership is connected with, and there are specific provisions about what happens when you have got a trust involved. I just can't pull up the. I'm sorry, my computer's being very slow. I just can't pull up the legislation at this particular point, but just being a trustee is not going to be, actually, let me just see if I can see it there. Just being a trustee is not going to be sufficient. Okay. A trust is connected with an individual who is a settlor, person connected with a settlor. Yeah, so that's probably going to be the main one. So yeah, it's not to do with the trustees, it's to do with the settlor. Okay. One of the other slightly ridiculous things about the partnership SDLT provisions, being completely blunt, is that when we look at partnership shares, we're looking at the income shares and not the capital shares. And obviously that can be quite difficult if you're looking at the SLP calculations, if the partnership shares have shifted over time. So that's another area where you have to be very careful. And the other thing that you do need to be very careful about is the fact that calling something a partnership doesn't necessarily make it a partnership. And owning property as joint owners is very definitely not a partnership. So you've got to be really careful. And if you have been reporting income, say for a husband and wife, just on their land and property pages and not submitting a partnership tax return, you have got to be really careful. HMRC do challenge these. We had a case last year, not actually involving incorporation of an investment business, but incorporation of a property business where a couple were developing their back garden, and they tried to argue that they'd formed a partnership that they were then going to transfer into a limited company in order to avoid the SDLT on getting it into the limited company. And in that case, actually, they were actually submitting a partnership tax return, but the revenue still argued that there was no actual partnership. I mean, they were a little bit naive about it, because basically there was not a single document apart from the partnership tax return which ever referred to the partnership. You know, there was no bank account. There were no invoices in the partnership names. There was nothing to demonstrate the existence of this partnership other than the partnership tax return. So they didn't really act very appropriately in that case. If you do form a partnership, you actually have to wait 3 years before you can incorporate using these provisions. And that is just to do with anti-avoidance provisions. And then there are still people who would argue that there is a risk that if the only reason that you're forming a partnership is to enable you to incorporate without paying any stamp taxes, then there are other anti-avoidance provisions that could catch you, although there is no evidence to date of the revenue actually making those challenges. So it is a really complex area, which is a really uncertain area. And I certainly advise a lot of people in this area and often don't get very far. One question I did skip over that had been asked previously, with many individuals owning investment properties, what number of properties would you suggest to incorporate the investment property business? It depends. It depends on what the activity is. And as I said to you before, I mean, if you've got someone who's got 100 investment properties, it's very definitely going to be a business, I would have thought, unless you actually have an agent that deals with absolutely everything. I would have thought you're going to have a pretty good argument that it is a property business. I think the issue arises when you've kind of maybe got 5, 6, because if you have got somebody else dealing with that, particularly if you have got other employment, it can be very, very difficult to argue that you have got a sufficient property business to mean that it's going to qualify. So that's a really difficult one. Okay, and that brings us to the end of that section. You know, if you do have any further questions, then obviously just pop them in and I'll come back to them before the next break. Just a very quick section really on construction industry, mainly because there were changes earlier on this year in relation to the construction industry scheme, which I will look at on the next slides. But let's just, you know, so that we all know what we're talking about. I'm sure everybody knows what CIS is. But CIS was is a tax deduction scheme that was designed to tackle non-compliance in the construction industry. It's been in place since about 1970 and has changed a number of times during that period. And I mean, when this was first introduced within the construction industry scheme, I think, you know, an awful lot of cash in hand work, an awful lot of people who were not registered, very much acting outside of the law. CIS has certainly made it more difficult, although it certainly hasn't stamped out all of the problems that we see with the construction industry, but that's the case. So the idea is that you have a contractor who engages a subcontractor to work for them, and they have got to be undertaking construction operations. Now, construction operations is building, modifying, destroying, demolishing buildings, basically. There are lots of different bits and pieces. There's a lot of guidance from the revenue as what falls within and outside of the construction industry scheme, and it's worth looking at that if you have any interest in it. So the first thing to think about is, what is a contractor? Contractor is a person carrying on a business which includes construction operations, and that person is described as a mainstream contractor. So that is somebody who is, you know, big house builders, you know, big commercial property developers, people who are buying property, building things on them, renovating things on them, very definitely earning their economic profit from construction operations. HMRC accepts that it is unlikely that somebody who has a property investment business would fall within that definition, because they are broadly going to be getting their economic value from the business by rent. However, they do caveat that by saying that if somebody who has a property investment business has a business model whereby they buy dilapidated property, do it up, and then rent it out, such that a reasonable proportion of their economic wealth derives from the construction operations that they're doing, then it would tip over into that. But I think that would be a business that was routinely doing a lot of that kind of renovation work. And I don't think that there is any particular evidence that the revenue do try and take that argument. You can also become a deemed contractor if you have got more than £3 million worth of expenditure on construction operations in the previous 12 months. So very, very large property landlords might fall within that category, but it's very, very unlikely that there would be many people. That's a lot of money. And yeah, again, there will be property investors, big property investors, who are going to fall within that definition, but there's not going to be many at all. So that's the sort of the basic issue that arises with property investors. We don't need to worry too much about it. But there was one specific issue that used to cause problems. And that was to do with a tenant carrying out work which should have been the landlord's responsibility, and receiving a financial contribution for doing it from the landlord. So this would sort of cover the type of situation where you've got a tenant identified very early on for a new build, and they agree that they are going to go in and do all of the sort of basic fit out work, you know, all of the cabling, the lighting, all of that kind of things, so that it is absolutely bespoke to their business. Now, that would normally be the landlord doing that. And so the landlord might say, well, okay, you do that work and we'll make a contribution towards it. HMRC's view was that this fell within the CIS on the basis that the tenant was effectively subcontracting that work from the landlord. Although they acknowledged that, you know, for example, the landlord offered a rent-free period, then he couldn't arise. Or if the landlord made a capital contribution, something like a reverse premium, where the tenant had absolutely no obligation to complete the work. So in some ways you could argue that it wasn't very difficult to get out of. And for other reasons, particularly associated with reverse premiums generally, it was often the case that in these types of situations, a rent-free period was the option of choice anyway, and the revenue didn't really think about it. What they've done now is that they have made a change in the regulations with the specific intention to remove doubt in relation to these payments, although again not entirely clear. If you meet these conditions, then the work is not going to be within CIS. So this is where a payment is made for works that have been agreed in connection with a lease or an enforceable agreement to lease. The tenant either does the work personally or they contract with a subcontractor to carry out the work, and that must be a contract with a registered subcontractor. The works are primarily for the benefit of the tenant, and there could be issues there. For example, if you had a tenant who was doing work on the common areas in the business. So it is not always going to be entirely straightforward. But now we do have some degree of clarity on that particular point. And in particular, we have some acknowledgement that it is unlikely that property investors are going to be within CIS, which is obviously a useful point to know. Okay. I'm going to talk about stamp taxes now. And actually, we've had a question in, what are the SDLT 3-year anti-avoidance provisions for incorporation and partnerships? Okay, so there's two areas. The first is that if you form a partnership, there is no SDLT because you are relying on the sum of the lower proportions in the same way that you would when you are getting property out of a partnership. Now, the SLP calculations for going into a partnership are slightly different from when you come out. So, you know, those provisions are there. And basically what it says, what the legislation says, is that if you form a partnership, you pay no SDLT or reduced SDLT because of the sum of the low proportion calculation. But you then withdraw capital from that partnership within 3 years, then you will go back and revisit the initial calculation of the sum of the low proportions. And effectively, you will get SDLT payable on any amount of the original value that you have taken out of the partnership. So that's a specific one which refers to 3 years. There is another general targeted anti-avoidance, sorry, that's an oxymoron, isn't it? There is a targeted anti-avoidance provision, which is section 75A of Finance Act 2003, which says that if you do something by way of 2 transactions and the SDLT is payable, that is payable is less than would be paid if you did it in a single transaction, then you pay the higher SDLT. So in the case of an incorporation of a property partnership, you transfer it into the partnership with the intention that after 3 years you're going to transfer it out. If that is preordained, then this anti-avoidance legislation might apply. Now, it's quite difficult to argue that something that happens 3 years apart is preordained. And I suspect that that's why we don't see many challenges under this legislation by the revenue. But if you were to form a partnership and then 3 years and 1 day later incorporate that, then I think that would be a situation where the revenue might well think, gosh, that's something that's worth looking at. Okay, stamp taxes. As I've already said, stamp duty land tax only applies now in England and Northern Ireland. We have land and building transaction tax in Scotland, land transaction tax in Wales. There are differences between them. I do think I need to point that out. But probably nothing particular in what we're going to talk about. Most of the current issues in relation to stamp taxes relate to the difference between the definition of residential property and non-residential property. Because if you have residential property, you have to pay the second home supplement. You've got the supplement for non-residents, you've got the ATED linked rate, Obviously, again, these slides were written before the budget. The supplement's now gone up to 5% for SDLT purposes. It's actually 4% for LBTT and LTT purposes. So there can be a huge difference. Stamp taxes are still payable on commercial property, but at a much reduced rate. So residential property is defined and everything else is non-residential. Residential property used as a dwelling, plus any land that forms the garden or grounds. So if you have something that's mixed use, it's non-residential. So not likely to be an issue where you've got things like factories and offices and so on. But where we do get issues is where you have got commercial property with a residential component. And I think the main issue that we have is farms or properties that have been farms in the past, but where the farming use has potentially lapsed. As I say, should not be any problems if there is current commercial usage, but there may well be situations where issues arise. For a long time, HMRC were winning every single case they took on residential versus non-residential. But we have recently had a couple of cases where actually the revenue has found for the taxpayer. This is really about residential properties that have got what might be described as slightly curious grounds associated with them. So the two cases that we've had, actually I think we've now had 3 cases where the revenue have found that property is non-residential. The first one, individual had a property, quite a big chunk of its property was woodland, and they argued that it was part of a bigger area of woodland, which was an ancient woodland managed by a trust management company, and the courts found that that property was non-residential, although that one perhaps is not quite as helpful as the others. Another one we had was where we had someone who was buying a property that had an artificial stream built in it, designed for breeding brown trout. And even though there was not current commercial use of the land, actually the courts decided that that was sufficient to make the property non-residential. So, you know, we are seeing some glimmer of light, but as I say, what you're looking for is where there is specific commercial usage of the property. I've got a really interesting case at the moment with a property developer, which is, you know, again, got a bit more of a commercial tilt to it. So if you buy a property that doesn't have a building on it, it can't be residential property unless you've started to develop it. So this property developer bought 2 properties together. One of them had a house on it and one of them didn't. The second one did have a house on it, but the original property owners had knocked that house down because they were going to try and get planning and sell it for development. There was quite a sturdy fence between the 2 properties, but it was marketed as a single property. And the revenue are basically trying to argue that the whole thing is residential because the second property is the garden or grounds of the first property. And from the perspective of this property developer, if the revenues succeed, I mean, there's a massive amount of additional tax to pay. The transaction will be completely uncommercial because they're not going to make enough profit on the development of the second property to cover the SDLT costs. So it is quite an interesting one. Okay, a couple of questions. Is SDLT payable if H, husband solely owns a property and wife has a separate property solely owned? They want to make each property 50-50 owned going forward. No CGT as interspersed transfer. If the properties are the same value as any SDLT due on the transfer, and neither are better off after the transaction. That is an exchange of interests in land. There is no exemption for transactions between spouses. Now, yeah, I think there would be SDLT payable in that situation. I can't see that there wouldn't. What is the SDLT position when you have a 6-bed bungalow which is used for care home for learning disability, where the property is rented to a trading care provider? Now, when we're looking at the definition of residential property, there are certain types of property which are not treated as residential. So there are some specific categories where you do have an exception to the treatment of properties as residential. Now, I'm just again pulling up the definition. So a building that is used as a home or institution providing residential accommodation with personal care for persons in need of personal care due to old age, disablement, past or present dependent on alcohol or drugs, or past or present mental disorders, would not be treated as a residential property. So I think in your situation, if it is residential accommodation with personal care for people who have got learning disabilities, I think that would not be treated as a dwelling. So that would be non-residential rather than residential. Okay, I have still got a couple of slides on stamp taxes, but actually it's just coming up to 11 o'clock. And so again, possibly that would be quite a good place to just have another brief break. So we will come back around 11:05 for the final hour of this session this afternoon, perhaps slightly after that. Again, if you have got any questions, do feel free to pop them in the Q&A box during the break, and I will see you shortly. Okay, so a couple of questions have come in. In respect of asked questions, would gift relief not apply as long as there is no mortgage? The problem that you've got is that there are special provisions where you are exchanging an interest in land. So in that example, so Val's example was the one where you had a husband who owned a property and a wife who owned a property, and they wanted to end up with each 50-50. You're absolutely right that if, say, for example, it was the husband just transferring an interest in property to his wife with no mortgage, then there would be no SDLT because there's no consideration. But in exchanges of interest in land, you are giving consideration because the consideration you're giving is the value of the other property that you are giving away. So it's not possible to just ignore it if there's no mortgage. So that is the issue there. Alan, thank you for your question. And again, I was kind of going to mention this and then forgot. So there was an anti-avoidance provision included in the autumn budget announcements, whereby if you have put property into an LLP and then liquidate the LLP, and transfer the property into a connected company, that there is a CGT liability arises. And Alan has said, can I foresee any circumstances when this new anti-avoidance provision might be relevant on the incorporation of property investment LLPs? I must admit that since we've had the budget, I have been running around a bit like a rabbit in the headlights, doing lectures, trying to read through all the stuff and do presentations, and I haven't really had any opportunity to sit down and think about this. But a couple of years ago, one of my clients got marketed an avoidance scheme whereby you formed an LLP and then liquidated it and transferred the property into a limited company. And the people promoting this were arguing that you didn't have the 3-year restriction in terms of the partnership. And they were also saying that you could, you weren't relying on Section 162, which meant that you could create a director's loan account in the company. And I did not think this scheme worked for various reasons, and the people promoting it, as is often the case, were very evasive about certain technical aspects of the arguments that they were putting forward. So in the end, my client didn't go ahead with it, but this would have caught that particular set of circumstances. And so I think what I'm trying to say to you, Alan, in a bit of a roundabout way, for which I do apologise, is that I think that this is targeted at specific avoidance schemes. Because in most situations, if you had an LLP and you were transferring it into a limited company and you were doing it and claiming incorporation relief, you wouldn't actually liquidate the LLP until after the transfer had been done. So you transfer the property out into the limited company and then you would liquidate the LLP. You wouldn't be transferring the assets as part of a liquidation. And the reason that they were transferring as part of a liquidation in the scheme that I saw was because that gave you the get out, or they argued it got you the get out of the SDLT problem and also enabled you to create a director's loan account. So I think that it's targeted at those kind of things. I can't see that it's going to have any impact. But as I have to say, I haven't had the headspace in the last week and a bit really to sit down and properly think about it. But now the finance bill is here, I will do that. But so watch this space, because I think if it is going to have any impact, I think that we will see publicity on that point fairly quickly. Okay, so staying with stamp taxes, a couple of points really. Group relief from stamp taxes perspective, and again, this operates the same in SDLT, LBTT, LTT purposes. Group relief is available when you have a group of companies and you want to move property around. As long as you remain within the same group, there are no stamp taxes arising, but it is quite important to remember that you've got to have that group. This doesn't apply with connected companies that are not within the same group. So effectively, you've got to have one company controlling the other, or both companies being under the control of the same company. And the test is a 75% beneficial ownership test, where you own at least 75% of the ordinary share capital. You're entitled to at least 75% of the profits available for distribution and 75% of the assets available on the winding up. And if you have a parent subsidiary relationship, or if you've got a number of companies within the same group, then you can move those properties around without there being any SDLT. It's something that we see done quite often for VAT purposes. If you have got somebody who's developed a property, they've got to transact it in order to be able to reclaim the VAT. I think, I'm not a VAT specialist, so I think that's the point. What they do is that they set up a subsidiary and transfer the property to the subsidiary. There's no SDLT, but it does work, and there wouldn't be any CGT either. but it does work for that purposes. You have to be slightly careful, and I think that this is why people often get a little bit twitchy about it. It's got to be done for bona fide commercial reasons. But again, I think the revenue take a fairly generous approach for this purpose. There can't be a case where effectively the group is going to be split. Consideration can't come from outside the group, and sometimes if money is loaned from shareholders, there can be problems, or the group relationship is to be broken. And then you also have a clawback of the group if the group relationship breaks within 3 years. So in most cases, group relief is fairly straightforward, but I guess it's just one of those things where I always think it's one of those situations where if there's anything, you know, vaguely strange about the transaction, then probably worth checking to make sure that you are going to qualify. And I appreciate entirely that that's a very woolly kind of what do we mean by strange, but I think that that's what we have got to be thinking about, really. Okay, sale of property business. One of the questions that we got asked before the webinar is, you know, how do you mitigate the gain on the sale of a property portfolio? And to a certain extent, that is an impossible question to answer because, you know, if you are selling an asset, there is going to be a potential CGT liability on sale of it. And, you know, you are looking to mitigate it by looking at some of the things that we are going to look at this morning. But there is no magic wand that you can use to avoid paying tax. And of course, since we have the changes in 2015 and then 2019, bringing in a capital gains liability, even where overseas property, non-resident individuals are disposing of property, then, you know, it does become very problematic in terms of how, you know, how this is going to be dealt with. So, you know, lots of issues to consider, and we're going to go through some of those now. I'm not entirely sure I'm going to get to the end of my slides, but I will do my best. So I suppose the first thing that we are looking at is trading versus investment. You know, what is the nature of the income that we are getting? Is it a capital gain? Is it going to be trading income? Now, obviously, from the perspective of an individual selling, then there's obviously a quite big difference between the capital gains liability and the income tax. That is not necessarily the case for a company. And ultimately, we are looking at the badges of trade, and the most important thing probably is going to be what the original intention was. If we do look at the differences between the two kind of situations, obviously in absolute terms, capital treatment versus, you know, income treatment. Use of losses. I mean, if you make a loss on the disposal of an asset, which is a capital asset, then you are only going to be able to set the losses off against your other capital gains. If it's an income loss, you may well have greater flexibility, but if there is a profit, there will be a national insurance cost. Now, it may well be that, you know, you have got higher levels of costs that can be offset against a trading profit. You can offset interest costs. There may well be a little bit more flexibility. I had a case a lot of years ago with the revenue where they came along and they tried to argue, or they were arguing that some transactions that my client had undertaken were were trading rather than capital. And we went back and had a look at the computations and actually went back to them and said, well, actually, if you continue to argue that it's trading, you'll get less tax because they borrowed money to buy these properties, and then the reason they were selling was because interest rates had gone up. They had other costs which were allowable, which would not have been allowable if it had been a capital gain, and so the revenue backed down on that one. Obviously, property where there is no trading, you won't get any BPR, but we're looking at the sale here, so that's unlikely to be the same. And obviously, again, for business asset disposal relief, which we will look at in a moment. If we assume something is a capital gain, obviously we start off by thinking about what the computation is, and then we would consider what reliefs apply. Enhancement costs are always quite an interesting one. And I do get quite a lot of questions about enhancement costs really from my clients. Obviously, the first thing you need to make sure with enhancement costs, or with costs that you are saying are capital, is that you haven't claimed those costs against your rental profits already. When you incur costs, particularly if you've got rental income, you may well try and put as many of those costs against your rental profits to reduce your income tax liability or your corporation tax liability if you're a company. That would then mean that you would not have those costs available to offset against your capital gain. There are then specific conditions for work that you have done on a property, extent to which the enhancement costs are reflected in the nature of the asset at the date of disposal. It's only the enhancement cost that you ignore if the asset's changed, not the original base cost. So, you know, again, it's just something that very occasionally you will come across. You know, again, I've had a case recently where someone was selling a property which they'd been using as their business premises, and they had built in the back garden some additional buildings that they were using for their business, had become very dilapidated. And the question that I got asked was, well, the purchaser wants us to knock down those buildings before we sell the land to them, because they're effectively going to redevelop it. And you know, basically the point is that if they knocked those properties down, they would not get the cost of building them set off against their CGT liability. It didn't make a massive difference because, you know, the cost hadn't been huge and they'd been there for a long time, but, you know, every little helps. You also, as part of the enhancement provisions costs, get any costs of establishing, preserving or defending the title to the asset. So if there are any disputes over, you know, what you own, how you own it, when you've owned it from, then those costs can be significant and they would be available. I think you do have to be quite careful though, because HMRC will challenge situation where they think the costs are not necessarily directly related to an asset that is being sold. There was a case a few years ago about a chap who was selling a farm, and he had inherited basically the property from his father. And he was an exec. I was just trying to remember the conditions, but the details of this case, which is why it's slightly vague there. He'd inherited it from his father, but he was the executor, and his brothers and sisters challenged his work as executor because they said that they didn't think his father's will actually left him this property outright. And he incurred a lot of costs, and effectively he argued that those were part of the cost of establishing, preserving or defending his title to the asset. The other thing that was pertinent in this case was actually his siblings didn't realise until after he'd sold this, and they didn't get any of the money. And And so it was after the sale that these costs had been incurred, and the revenue successfully argued in front of the first tier tribunal that actually this was more about the management of the estate rather than defending title to the asset, because the siblings in their court case said, actually, we're not that bothered about getting the property, we just want the money. So they wanted to be financially compensated. They weren't bothered about actually owning any part of the asset. So, and as I talk about it, I do acknowledge that it was quite a tough decision, but that was something that was there. Question has come in on the trading v capital. Trading partnership was set up 10 years ago, bought a large dwelling house, spent £1 million converting it to 7 separate leasehold flats. They were set up they were intending to sell them, so they were classified as stock. The local area was being redeveloped by the local council, so they held the flats for 5 years to benefit basically from the bump in value from the regeneration of the local area. Could HMRC argue this is not a trade, as not sold any property, if we were to incorporate and claim CGT and SDLT reliefs? I think as long as you've got evidence that that was your intention when the properties were bought, sorry, because it does tend to be your intention at the time that the property is bought that is pertinent when we get these kind of arguments. Now, the bigger risk might be that the revenue say that when they made the decision that they weren't going to sell, that they should have been recategorized as capital assets at that point, at which case there would have been a trigger of the tax charge on the uplift in the profits at that stage. I would have thought that that might be the bigger risk, but we don't see the revenue challenging those very often. So hopefully that wouldn't be too problematic. Going back to our disposal, don't forget that there are 2 pieces of legislation which impose a market value on the transaction. The first is where the transaction is a bargain other than at arm's length, and all the revenue would have to do is show that it's not arm's length. This is one that we don't see the revenue challenging very often either, and I think probably one of the reasons that it doesn't get challenged that often is because it's quite difficult for the revenue to prove, because selling something otherwise than at arm's length is not the same as doing a bad deal or potentially needing to sell at a reduced price. I mean, if you've got a property and for whatever reason you need the money from selling it, then you might accept a lowball offer on that property. And, you know, for reasons which are your own. I mean, I've recently sold my mother's property, and in the end I accepted quite a low offer on it because it had been on the market for quite a long time, and the estate agent was saying to me, oh, well, if you hang out you'll get more for it. And I just made the decision that I wanted rid of it. And, you know I was very lucky to be in that position, but, you know, it's not an easy one for the revenue to prove. Transactions between connected parties, you always impose market value if the deal has been done at any other price. So you have to be quite careful. And on transactions between connected parties, you mustn't forget clogged losses. Very rarely come across clogged losses. I've had about 3 questions about them in the last fortnight. I don't know why particularly. So if you transfer a property, even if you transfer it at market value to somebody that you are connected with, then those losses can only be utilised against the transactions with the same person. So you've got to be quite careful about that if you are undertaking those kind of transactions. So yeah, just a warning really. Beyond that, your allowable costs are any costs of acquisition or disposal, and that would include things like fees, commission, any remuneration paid for professional services, and any costs of conveyance or transfer. So your estate agents, your solicitors' fees, all of those kind of things. Getting valuations for CGT purposes. Occasionally these amounts are under dispute. Obviously with commercial property, there can be difficulties in terms of things like getting planning permission, building regs approval, environmental assessments. I mean, if you are incurring those kind of costs other than when you have bought or sold the property, HMRC can occasionally get a bit twitchy about whether they are allowable. I mean, obviously, if you are doing any enhancement work to the property, so if you are, building an extension onto a commercial property or something like that, then normally things like the planning permission and the building regs and so on would come in as part of the cost of the capital cost of the extension. So you would get them sort of kind of through the back door. Environmental assessments can sometimes be a bit more difficult. Although, again, I mean, if you're doing that in anticipation of sale, then again, they should be allowable. I have had a few queries from the revenue on these particular points. Obviously, in terms of mitigating the gain, business asset disposal relief might be quite nice if you have got property used for the purposes of the business, although I would say that another announcement that we had in the budget is that the rate of BADR is going up to 14% from next April and 18% the April after. So the benefit of being able to achieve BADR is going to disappear slightly, unfortunately. So, again, it is going to be potentially a bit problematic in terms of whether or not it is worth it trying to achieve it. But if you have got commercial property that is being sold as part of a wider business sale, or if you've got property held outside a company or a partnership, then it may well be possible to get BADR. You can only get BADR on assets that are sold as disposal of all or part of a business that has been run for 2 years up to the date of disposal, or you sell it post cessation, and then you have to sell the assets within 3 years. There is no restriction on what you use the assets for post cessation, but there's also no facility to extend that 3-year period. One of the things you need to be quite careful about is, making sure you know when you actually ceased and the date at which you actually ceased. And an example of the kind of situation that you might find is problematic, and this is a case I had a few years ago. Chap had a pub business which had become unviable, and actually this was before COVID, so that shows you how long ago it was. And he'd done nothing with the business premises which he owned, and then he started to try and get planning permission to convert it into flats, and we were approaching the point at which we were at the end of the 3-year period for him getting BADR, and this was at a time when BADR was 10% and £10 million worth, so it was very well worth doing it. In that situation, we had a couple of options: transfer it to a limited company, although there would have been SDLT implications of doing that, or we could simply have appropriated it to trading stock, so setting up trading as a property developer, appropriate the land to trading stock, and then effectively crystallizing the gain. In that situation, you can, if you want to, hold over the gain. But what you do if you don't want to is, if you don't hold over the gain, you appropriate it to trading stock, pay the tax, obviously as long as you've got funds to pay any BADR that arises, then you have that flexibility. If you're not ceasing trading, but you are selling the business, then in order to get BADR, you've got to be selling all or part of the business. I mean, obviously, sale of whole of the business is fairly straightforward. Part of a bit sale, part of the business is not defined. What HMRC say is that if you're selling part of the business, it's got to be a defined part of that business that is capable of operating as a single entity. And one of the things that you've got to be slightly careful about is that if you're only selling part of the business, what has got to be there afterwards has got to be different rather than smaller. We've got a number of cases on this concept deriving from a time when retirement relief was relevant, but we haven't really got a great deal from entrepreneurs relief or BADR relief purposes. So, but given that you don't get BADR on on property investment portfolios, you only get it when you're selling a trading business. It may well be less of an issue for property investors. If you hold a property outside of a company or a partnership and you sell that property at the same time that you make a disposal of the associated business, the legislation does say that you've got to be doing this as part of the withdrawal from participation, but in practice, that isn't really enforced. And you must have had the asset for at least 3 years, ending with the date of disposal or the date of cessation. And there must be nothing in place whereby the bit of the associated business that you've sold in order to make it an associated disposal is going to come back. And then there are various other conditions that have to be met. If you have an associated disposal, then the gain may not completely qualify for BADR if the asset is only partly used for the business, or if it's not being used throughout the period of ownership, or rent has been paid for the use of the asset. Although in a slightly bizarre move, we only consider rent as being paid post 6th of April 2008. And if it's not market rent, then you would pro rata. Just as an example, chap's got a partnership, he operates a restaurant 2 floors above the restaurant, one which is occasionally used for storage by the business, and one which has a flat which is rented out to a friend of his daughter's. The floor area of each part is the same. And the question is, how would we apportion the gain? And how would you treat the floor used for storage in terms of qualifying for BADR? Well, you would apportion the gain a third between the 3 floors. And I think in that particular case, you'd probably have a good argument that the floor used for storage would qualify for BADR. Obviously, it depends what we mean by occasionally used for storage. If you just put a few extra boxes of food in there in the fortnight before Christmas each year, that might not be enough, but you'd have to take a judgment about it. There is another quite interesting point that it's worth remembering, and that is, whilst we have apportionment provisions clearly applying for associated disposal purposes, such that any non-business use will generate a gain which is not covered by BADR, apportionment doesn't apply for assets owned by sole traders or partnerships, as long as the building is primarily used for the business. So if we go back to that previous example, if Sajid actually moved the business premises into the partnership, there would be no apportionment, there would be no restriction on the capital gain for the flat rented out to his daughter, assuming that the middle floor was used for storage, because more than 50% of the property is used for the business, and therefore you wouldn't get any dilution of that. A company sold the, sorry, questions come in. A client sold the commercial property used by the limited company, and diluted 20% of their limited company share at the same time, can they get the ADR? Assuming that rent has not been paid by the limited company for the use of the commercial property, then the dilution of the shares would be a material disposal, and therefore you would be able to get PADR, hopefully. Rollover relief is obviously available where you have got property being used for the purposes of the trade, where trader sells an asset and buys a new one. It can apply for unincorporated businesses, or it can apply where somebody is using it for their trading company. The reinvestment must be undertaken within a period starting 2 years before, 3 years after. It must be a qualifying asset, but a real estate would fall within that. And if you don't reinvest immediately, you can defer the tax. If you don't reinvest all of it, you can claim partial rollover relief. And it also applies for rolling over into fixed plant and machinery. So again, that's mitigation, where you're actually holding property and using it for the purposes of your trade. There is a calculation, which I'm not going to go through because I'm running out of time, but it's there on the slides if you want to have a look at it. Holdover relief is where you are transferring an asset which qualifies as a business asset, and you are transferring it at undervalue. There's two reliefs, one which is kind of called rollover relief, which is very unhelpful, but that's not available if your asset is a depreciating asset. Oh no, sorry, this is still rollover relief. What am I talking about? Oh no, sorry, I've got confused. I do apologise. Holdover relief is the name that's given when you've got rollover relief. Actually, I just got excited about the fact that we've not got much time left. I'm trying to hurry through these slides so I get to the end of the material. I do apologise. Rollover relief is the default where your gain arises, but there is something called holdover relief, which is available if the asset is a depreciating asset. And basically, you don't roll the gain over into the new asset, but you actually defer it until the earliest of 10 years, the date of sale, or the date that the asset ceases to be used in the business. Although you can reinvest back into another asset if you want to. And an asset is a depreciating asset if it has a useful life of less than 60 years. Now, that is going to be something that we will see for leases. So if somebody sells a freehold and buys a leasehold property, then that might be an issue, takes out a lease. So there's probably not a great deal else to say about rollover and holdover. Obviously, gift relief is available, and I thought I'd put some slides in that, which is why I got confused, but that is not the case. I suppose the only other thing with rollover relief is that there can be some issues arising where you have got a mismatch between what you are selling and what you are buying. And what I mean by that is that you can only claim rollover relief if the asset is used in the trade at the time of this disposal. And so if you have stopped using an asset for the purpose of the trade, then you can have problems if you sell that and reinvest the money. There's got to be trading activities. And to be honest with you, the kind of situation where I see this most often is in relation to farm diversification, where you have perhaps got, bits of farmland, or you've got old farm buildings that have been converted into offices or something like that. And on the other end of the scale, you have got to, if you're buying a new asset, you've got to bring it in as soon as is practical after it has been purchased. So if you have got an asset which, say, needs refurbishment work doing on it, then you need to make sure you get on and do that quite quickly. So, you know, it's one of those issues where it is certainly possible. As I say, holdover relief is another one where you are effectively gifting assets. And I think we are potentially going to see a lot of people thinking about holdover relief in relation to furnished holiday let properties. Because if you own a furnished holiday let property and it's not potentially going to earn you as much money after next April, you want to get it outside of your estate from an inheritance tax perspective. Gifting it to the next generation now might be a good way of thinking about mitigating your future tax liabilities. But obviously it's quite difficult because, you know, if you've got a portfolio of furnished holiday let properties and you're living on the income from that, somebody like you or I coming along and saying, well, yeah, what you need to do is transfer that property to your kids. And then you're thinking, well, okay, that's all well and good, but, you know, what am I going to live on? So, you know, again, from a practical perspective, it's not always that straightforward to say, well, okay, give your assets away if you are living on the proceeds. Final quarter of an hour or so, I'm just going to talk very quickly about the capital gains issues for non-residents, because again, even though I know I've covered these before, there are I get asked lots of questions about these. And again, there are sort of people thinking about planning around this, particularly with the non-domicile rules changing and people perhaps thinking about going offshore. So for a long time, actually, if you were non-resident, you didn't have a great deal of exposure to UK capital gains tax unless you actually had a trade in the UK through a branch or agency. And 2015, temporary non-resident rules, of course, as well. So if you left the UK and were out for less than 5 years, then you were subject to CGT on any assets that you'd sold while you were away. 2015, charge was introduced for residential property, and then 2019, commercial property comes into charge for UK, as well as the shares in property companies owning either residential or commercial property in the UK. So there was a whole-scale reintroduction of income from of capital gains for non-residents. So for commercial property, as I say, came within scope from the 6th of April 2019. There are two mechanisms for calculating the gain. The first is to rebase the cost to April 2019 so that you only pay the tax on the uplift in value since that date. Or you can, if you wish to, elect to have the whole gain or loss brought into account. I can't particularly think why you'd ever want to have the whole gain brought in, but certainly if you've made a loss, you might want to do that. What you can't do, which you can do for residential property, and again, people do sometimes get a little bit muddled about this, is that you can't time apportion the gain. Effectively, with residential property, you can work out the total gain and then time apportion it, which means that, you know, for example, you don't have to get a valuation, but you can't do that with the commercial property anyway. For an indirect disposal of UK property, and that can also apply to a company holding commercial property as well, two conditions that you've got to meet. That is that it's got to be a property-rich company, and you've also got to have a significant holding in the company. We'll have a look at those in a moment. So sometimes mixed use property can give us problems, although I have to say, from a practical perspective, I'm not sure that I've ever come across this in reality. If you've got mixed use property, then you simply have split rebasing points. So if you had, say, a shop with a flat over it, and you were non-resident and you'd held that since, say, 2000, what you would have is effectively you would treat that as two separate properties. You would have the commercial property, which will be rebased back to April 2019, and then you would have the commercial property that would be rebased, no, sorry, the residential property that would be rebased back to 2015. And so you would have the gain, you'd split the proceeds between the two bits of the property, you'd have the dual rebasing, and then you just calculate the gain on that basis. I think one of the things that can be quite difficult when you are looking at different rebasing points is where you have had sort of work done on property, because the kind of logical way to approach this is just to sort of split the sale proceeds on a it depends when you buy it, actually, I suppose, but you do, I suppose the point I'm trying to get to, and again I'm waffling slightly, which I do apologize, you really do need to get the valuations, because it's not something that you can really sort of do on the back of an envelope. I'm amazed with non-resident CGT, actually, with the number of people that do just sort of do slightly ad hoc calculations without really having any basis for doing that. If your property has changed use, then you rebase twice, and then any gain which arises between 2015 and 2019 is apportioned depending on the usage between those two dates. So if you've had change of use before 2015 or after 2019, it will be fairly straightforward. But if it's between those two dates, then you do rebase it, but the gain doesn't actually come into charge until you sell the asset. So if we look at an example, someone buys a residential property, converts it to commercial use during the period between 15 and 19. So you rebase it at 2015. There's a gain at that point of 50,000, but it would not be chargeable. There is a deemed disposal and reacquisition at 2019, which gives a gain of 25,000, and that gain will be taxable. 3/4 of it will be taxable because it was a residential property for 3/4 of that period. And then the gain from 19 to when it is sold, which is £75,000, will just be taxed as normal. So the total gain in that situation would be 93,750. But again, it's another transaction where effectively, we don't see these very often. And so, I don't envisage that you would come across this very often. Indirect disposals, again, my sort of exposure to questions about indirect disposals tend to be doing calculations for people where they've got an overseas individual who's got shares in a property company owning a property in the UK, and they're wanting to effectively extract the property from the company. They don't see any advantage in keeping the company going, and we're trying to work out what the tax implications are going to be. So I did one recently where effectively we have a chap, he's a Cypriot chap. He owns 100% of the shares in a Cypriot company which owns a UK residential property, and he wants to effectively gift that property to his son, but his son is going to live there. So actually, oh sorry, his son is UK resident. His son is going to live there, so he wants to own the property personally rather than own it through a limited company. And so we've been looking at how we can sort of sort this out in order to minimise the tax liability. So indirect disposals, so disposals of shares in property companies, are rebased to 2019. Residential property is rebased to 2015. So if he transfers the shares to his son, and then that would be a disposal rebased back to 2019, the property is then distributed to his son. That would be a disposal in the company back to 2015. The son wouldn't have any capital gain on the winding up of the company because he would have acquired his dad's shares at their current market value. If you distribute the property to the dad first, again, the company will have a gain based on the 2015 valuation. The dad will acquire the shares with the property at market value, and so he can then gift it to his son without there being any additional liability. So in the first instance, it seems like actually you're much better off to distribute the property to the dad and then transfer the property to the son. The only problem is that actually we did a load of planning around this, and then it turns out that there was loans outstanding, which causes a bit of a spanner in the works from an SDLT perspective. But anyway, if you've got shares, if you dispose of those shares and they derive at least 75% of their value from UK property, then you are going to have a gain on the disposal of those shares. So we're looking at the gross value in terms of the 75% value. When we're looking at the valuation of the shares, you can take account of liabilities, but in terms of working out whether 75% of the value is derived from UK property, we wouldn't take account of that. So, you know, what we've got is relatively straightforward situation. If we have got, as is often the case, you have a UK property company. I do very occasionally come across situations where we've got overseas wealthy families who have got a family investment company. Part of that portfolio includes property within the UK, such that the 75% limit isn't actually met. But that is probably fairly unique. You've got to have at least a 25% investment in the entity, and basically, unless you've only had that kind of level for a very insignificant period. So if you set up a property company and you happen to have the subscriber shares, and then further shares were issued to other family members, and so yes, at one point you did have 100% ownership in that company, but now it's much less than that, then that would be ignored. And in terms of the 25%, we're looking at voting power, rights to income, rights to assets, although we have to take account of the rights of associates. Although not siblings. There's also an anti-avoidance provision which says that if you do anything if you enter into any arrangements with the purpose being that this legislation doesn't apply, then it will apply. And the kind of examples that the revenue give is manipulating company assets such that it's not property rich when you sell them, ordering transactions to enable the disposal occurs after the company ceased to be property rich, And that, I suppose, could potentially apply in my client's situation. Linking transactions to avoid it, making there are some exemptions from these provisions, I should say, and one of them is a trading exemption, and there are arrangements associated with this. The example that I always give is that I had a case a few years ago. I was involved in a case a few years ago. Wasn't my client, but I was brought in to look at this for various reasons. 4 brothers each had 25% of a large property portfolio, which was worth about £85 million. And they held it as a partnership, but they wanted to get it into a limited company. They were going to claim incorporation relief. They were going to mitigate the SDLT using the partnership provisions which we've discussed. One of the brothers was going to become non-resident and gift the shares in the company to his kids, but he wanted to have less than 25% of the shares in order that he wouldn't be caught by the anti-avoidance provisions, by the non-resident disposal provisions. And so he said, okay, I know I have 25% of this property portfolio now, but I'm going to have 20%. Actually, this is being slightly more generous because he was going to have 24.5% of the shares in this property company. And I was raising the question, was this caught by the anti-avoidance provision? My view was that it was caught pretty much because he was entitled to 25% of the shares in this company, and he only wanted 24.5% so that he could avoid the application of this legislation. I think if we set the example at 20%, it's perhaps slightly more arguable, although not a great deal. Right, sorry that I've ended up rushing that last bit a little bit, but I know that's all stuff that we've covered before. Anyway, that brings us to the end of this session. Thank you very much for your time. I hope that you have found it useful. I think I've answered all of my questions. So unless anybody has got anything else that they want to send through, then please do so, and it will be forwarded on to me by the hub. But thank you very much for your time. I can see that there is a message in the chat box saying that the CPD, the K3 Hub CPD programme starts again early next year. And so even though it is very, very early, happy Christmas. Thank you and goodbye.